We'll talk about Suncor Energy. Key statistics: 69 billion market cap, net debt to FFO ratio Q1.6 times, oil sands reserve life 25 years, upgrading capacity 556,000 barrels per day, refining capacity 466,000 barrels per day, which makes them an integrated player. Production to market 853,000 barrels per day, so massive producer in Canada. Refinery utilization 104%. AFFO Q1 3 billion, capital expenditure for Q1 1.1 billion, and free funds flow in Q1 was 1.9 billion. To the balance sheet is required for Q1 to better understand the debt dynamics and the funds flow dynamics. So as mentioned, free funds flow in Q1 was 1.9 billion, but it didn't really change much from previous quarters and from Q1 in 2024, which was about 1.858 billion. So very steady free funds flow production numbers here when it comes to free funds flow, also known as free cash flow. Now, when it comes to debt, that kind of increased here from 6.8 billion. It was much higher in Q1 2024, but now it's about 7.5 billion in debt. And as mentioned, enterprise value now is considered a market cap of 69. We need to add 69 to 75, so we get about 75.5 or 76 or so, depends on stock price, in enterprise value. Suncor has a strong cash returns and resilient balance sheet record. As seen in the chart here, cash yield is kind of a little bit higher, I guess, versus a peer average. And on a cumulative basis, you could see that it's kind of heading towards the $40 billion or so in cumulative cash returns. And when it comes to their debt, as mentioned previously, manageable debt maturity profile, when it comes to the timeframes, it's only 2.5 billion that's maturing between 2025 and 2029, and then 1.7 billion between 30 to 34, and the rest is afterwards. Cash flow back to shareholders, it's at 100%, which they suggest is a disciplined capital allocation. So they return basically at or near 100% of excess funds flow to shareholders via share buybacks. They achieved the net debt target of 8 billion in Q3 2024, as mentioned in previous slides, and they committed to a reliable growing dividend, targeting 3 to 5% annual growth, and ensuring financial resilience, targeting 1 times net debt to AFFO at $50 US WTI, so low cost of supply producer. Proud of their integration. They suggest here that where there's Suncor, there is integration. Their activities are from Fort Hills Base Plant, in situ, which they utilize SAGD recovery scheme, Syncrude, Commerce City in US, logistic and trading, Edmonton refineries, retail, so the famous Petro-Canada stations, Montreal refinery, East Coast recovery facilities in Sarnia. So in upstream production, oil sands mining, oil sands in situ, and East Coast offshore, so 825,000 barrels per day. Obviously, it was a little bit more in Q1. Refining capacity 406,000 barrels per day between Edmonton, Montreal, and Sarnia, and product sales of about 570,000 barrels per day equivalent in their Petro-Canada stations. Risk and 7 billion barrels of 2P reserves. Their production mix in 2025 is majority is in oil sands operations. For the mining activities, they basically have zero decline, so very little decline. About 10% in situ SAGD declines. Corporate decline is about 5%. Fort Hills mining 0% decline, Syncrude 0% decline, and in their E&P 15% decline activities. When it comes to mining, the decline rate and reservoir risk is very low, but the recovery factor is very high. When it comes to in situ, the decline rate and reservoir risk is very low, and also recovery factor is very high. So basically, you can recover a lot of oil in low cost of supply, low declines, and very little risk. Offshore, the risk is medium, as defined for all decline rates, reservoir risk, as well as recovery factors. And in tight oil operation, the risk is very high, except the recovery factor. integrated footprint of all oil sands. You can see Fireback kind of on the east side, mining upgrading operations. Everything is integrated north of Fort McMurray between the Fort Hills and Base Plant, Syncrude, Fireback, Mackay River, and the little piece of the puzzle there that sits in the middle, it's Sunrise, which is a Cenovus asset. So in the future, this piece of puzzle, in my view, should be filled, but I'm just a guy. What do I know? Strategy: maximize margins and keep upgraders full, 90% utilizations. Optionality for multiple oil sands assets, mining and in situ. And all sites are connected by pipeline, as seen in the image. So Fireback, Mackay River, Base Plant, Syncrude, Base Plant, Fort Hills, Base Plant, in close proximity to significant assets, right? Optimize consolidate storage, water housing, and supply chain management, consolidation of regional contracts. So that kind of gives them an edge, kind of being concentrated in one area. Industry-leading refinery utilization and profitability. Operational execution much higher than US average and Canadian average. So they're basically running at very high average annual utilization, especially 2024, 2025, and industry-leading profitability. So the refining EBITDA per flowing is much higher than the peers, north of $20 per barrel. Showed in Q1 earnings, they had free funds flow of about 1.9 billion. So this number is increasing here from 2023 towards 2024. So they're very much aware of returning basically value to shareholders in the form of free cash flows, and they suggest they have record upstream and downstream volumes. Achieved 8 billion net debt, which they did. Shifted to 100% return to shareholders in Q4, and returned 5.7 billion shareholder return, which is basically an 8.8% cash yield. Budget for 2025, they're going to spend between 725 to 775 million in exploration and production, between 325 million to 350 million in situ well pads, and other economic investments between 1.5 to 1.6 billion, resulting in a range between 2.6 to 2.7 to 5 billion. And when it comes to kind of the oil sands, downstream and corporate asset management sustaining operations, it's going to be between 3.4 to 3.57 billion. In overall, the capital budget spend will be between 6.1 to 6.3 billion. So that if you use that as a ratio of the free funds flow, you see the free cash flow basically based on what was recorded in Q1 is higher if you kind of compound that over the 12 months time period in 2025 relatively to their capital budget. Capital and production guidance, they're going to be producing total upstream production between 810,000 to 840,000 barrels per day. We saw over 850,000 in Q1. If you look kind of at total bitumen production, it's going to be between 880,000 to 920, but then they also upgrade and have non-upgraded bitumen, and that's kind of how they combine their production. If you look at by asset, the oil sands operations is between 445,000 barrels per day to 470,000 barrels per day, and the cost of supply, cash operating cost, basically is between $26 to $29 per flowing. For Fort Hills, for example, 165,000 to 175,000 barrels per day guidance, and the operational cost there is between $33 to $36 per barrel. And for Syncrude is between $34 to $37 per barrel, where production expected this year is 190,000 barrels per day to 200,000 barrels per day. So you can see it's a low cash operating cost producer. Refinery throughput is going to be 435,000 to 450,000 barrels per day. Refinery utilization 93,000 to 93% to 97%, and the refined product sales 555 to 585,000 barrels per day refined product sales. Energy sources, mining upgrading, Base Millennium North, Steep Bank region, Base Plant upgrader, Syncrude, Mildred Lake, Aurora North, Syncrude upgrader, and Fort Hills. When it comes to their activities, in situ Fireback and Mackay River, with a lot of focus on Fireback. Production there is significant, one of the biggest assets, SAGD assets in the products markets, 600,000 barrels per day product sales in 2024, You can see the network on the map, very integrated to North America, 20% Canadian consumer fuel market, 320 wholesale cardlock locations, 1,640 Petro-Canada retail sites, and 45% of North American retail sites Suncor owned, as seen as in the map. In 2025. Hopefully you enjoyed this presentation. Please like and subscribe. Thank you.